Hello, welcome to Chapter 3 of Fundamentals of Financial Accounting. Before we start here, I would like to remind you again to visit Canvas and download a blank set of notes for this chapter so you can fill them in as we proceed onwards. Starting with the time period assumption, this ensures that accounting information is reported regular intervals. So we assume that any sensibly run business would report numbers and other accounting information in a consistent, ongoing manner. The accounting period is what is reported by the financial statements. The most basic one is 1 year. Most companies produce annual financial statements. However, managers and other financial statement users often need information more frequently, so shorter periods are also reported on. So some examples, there might be monthly reporting, there might be quarterly reporting. Those are pretty common. A fiscal year is a company's year-long reporting period. The most common fiscal year is from January 1st to December 31st. Any fiscal year-end date can be chosen, but it's simpler to choose a low point in the business. So for example, if you have a retail business and you find that in December, a lot of sales happen, people have their Christmas shopping, they have their year-end bonuses. So you might say, that's a pretty hectic time for us to be preparing year-end financials. Maybe we should have our year-end on September 30th. Moving on to revenue recognition criteria. This principle covers two broad concepts about revenue recognition. First, when to record revenue. Accountants should only make a journal entry to record revenue after we have completed a good or service. Second, the amount of revenue to record. This is a pretty straightforward concept in the sense that the dollar amount received for the good or service should be the amount of revenue recorded. So something to be wary of as an accountant. Depending on the situation, managers may prefer to either understate revenues, which is typically to avoid taxes in a cash deal, for example. You work for cash and you decide not to report that cash you earn, or you might overstate revenues. So if it's a publicly traded company and good results make your stock price go up and you have your own bonuses which depend on the stock price, it may be in your best interest to overstate revenues. So you got to look out for both those scenarios, and we'll touch on them later. Expense recognition criteria is also referred to commonly as the matching principle. So to apply the matching principle, we have to apply 3 steps. First, we identify all expenses incurred during the accounting period. Second, we measure these expenses. And third, we match the expenses against the revenues during that period. So the best way to illustrate this is to start off by looking at our formula for net income again. And this is a nice visual graphic representation of the concept. We have our revenues of 1,000 and our expenses of 700, and we end up with net income of 300. So revenues minus expenses equals net income. The main point behind this illustration is to emphasize the importance of linking expenses to revenues in a given period. Only expenses which can be linked to revenue generated in a period should be included in our net income calculation. For example, let's say that SFU Bookstore manufactures fridge magnets for retail. If 1,000 magnets are manufactured this quarter at a cost of $2 each, should the cost of production be immediately expensed in the current period? The answer is no. We can only do this if all magnets produced were also sold within the same period. According to the expense recognition criteria, the expense of each magnet must be linked with the revenue of each magnet. Therefore, if all 1,000 magnets are sold next quarter, in quarter 2, for $3 apiece, we would expense the $2,000 cost of production in quarter 2. The magnets will be shown as inventory in quarter 1 end balance sheet, since they are assets which are expected to benefit the bookstore in the future. So let's look at a question here. Assuming we correctly recognize revenues and expenses for both quarters, so this is quarter 1 and quarter 2, but all the magnet sales were in quarter 2, what would be the revenues, expenses, and income added from the magnets in quarter 1? So take a minute to try this, and we will go over the solution in the next video.